Welcome to the Women in Wealth podcast, brought to you by Regina McCann-Hess, a certified financial planner with over 2 decades of experience. This show is for professional women who want guidance in working towards their retirement vision in learning, building, planning, striving for your dreams, and putting the work in now so that you can pursue your financial independence. Hello, I'm Regina McCann-Hess, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about one of my favorite topics. It is Social Security again. I don't think you can hear it enough. So I am going to talk about 10 key facts about Social Security benefits. And there's a lot of different things that we could talk about with Social Security, but we're just going to limit it to these 10 quick hits, not going too deep into it, but I think it's good information. Things to keep in mind before claiming Social Security. One of the first things is to know what the eligibility for Social Security retirement benefits are and what's determined by your work history. So in order to qualify for these benefits, you must have earned a minimum number of credits over the course of your working life. And what is the minimum credits? It's usually 40 quarters of earnings or 40 quarters to be eligible for Social Security benefits. So that's the big thing there. That's your first hurdle. Number 2, changes to your status and some of the following things could have a positive or negative impact on your retirement benefit amount. So your retirement benefit will be determined on the basis of your work experience, your average earnings over 35 years, and the age at which you begin taking benefits. And we'll get into that in a minute because I talk about it all the time. Okay, point number 3, the year of your birth and the age at which you start taking Social Security can directly impact or affect the amount that you receive. So if you choose to receive retirement benefits before your full retirement age, your benefits will be reduced permanently. Have we heard this before? Yes, we have. For an example, if you're born before 1960 or later, your full retirement age is 67. So your full retirement age is 67, but if you're eligible or you start to receive your benefits at age 62, the early retirement age, your retirement benefit would be permanently reduced by 30%. Like over your entire lifetime, your benefit is going to be 30% lower for the rest of your life. So not a good plan for the most part, right? However, if you wait till age 67, you get your full retirement benefit. And then they also have a little carrot here. If you wait until you're 70 to start receiving your benefits, your retirement benefit would be increased by about 24%. Starting early, you'll lose 30% if you started at age 62. 67's the bullseye. That's when, your full retirement age, you can get your entire benefit. And if you delay until age 70, you get extra money. So that is something to think about. Number 4, while you are working, while you take Social Security, may cause your Social Security benefits to be temporarily withheld. So if you're younger than your full retirement age and receiving any kind of Social Security benefit, there's limits on how much you can earn without affecting your benefits. And when you reach your full retirement age, those earning limits no longer apply. So it's another reason not to take your retirement benefit from Social Security any earlier than you really should. And in my opinion, it's minimally your full retirement age. Now, don't get me wrong, there are circumstances where you do need to take it sooner, like a serious health event where your life expectancy is much lower and a couple other reasons. But for the most part, you want to wait until your full retirement age. So here's some of the nitty gritty on that one. If you're under full retirement age for the full year, your earnings limit in 2025 is $23,400 for the year. That would be roughly $1,950 per month. So if you make more than that, you're going to have $1 in benefits withheld for every $2 in earnings above that limit. So if you're making more than that $23,400, you're going to lose $1 in benefits for every $2 above that limit. So again, something that you really do need to know. When you reach your full retirement age during 2025, so if you're turning 67 this year, your amount that you can earn is up to $62,160 or $5,180 per month. And that would be $1 in benefits withheld for every $3 in earnings above that limit. So making over 62,160, anything that you make over that, you're going to lose $1 in benefits for every $3 in earnings. So another give back there during that year that you turn 67. Once you turn that full 67, the month that you turn the full retirement age or older, there are no restrictions. No restrictions on your income. You can make as much as you want. And there's no restrictions on the amount of withholding. So they're not going to withhold anything. Again, if you're working, you may want to rethink taking Social Security early, one, for the amount of benefit that you would decrease, but also you have to give it back and because of these rules in place. So another thing that kind of makes you stop and think about, oh, do I really want to take those benefits early? Tip number 5, benefits paid to you as a spouse will not decrease your spouse's retirement. So if there's a divorced spouse who qualifies for benefits, he or she is not going to affect the total amount of benefits for you or your spouse that you may be eligible for or receive. So what does that mean? So a lot of people think, oh, okay, if I take his or her benefit, it's going to take away from their benefit, like spouse A versus spouse B. If spouse A takes spouse B's benefit, then spouse B is going to lose something. No, they get their full benefit. It doesn't impact them whatsoever. So if you're a spouse that needs to rely on that, then that is something that you can do and it's not going to impact the other spouse. So again, you may be eligible for a spousal benefit if you're at least 62 years of age and your spouse is receiving their retirement or disability benefit. Tip number 6, your spousal benefit can be as much as half of your spouse's benefit at their full retirement age. So in order to receive a spousal benefit, your spouse must be receiving their retirement benefit. If you receive a spousal benefit before you reach full retirement age, your spousal benefit amount will be reduced and will not increase when you reach full retirement age. Remember, they're going to penalize you for taking it early, just like they would for your own benefit. So if you're eligible for both your own retirement benefit and a spousal benefit, the Social Security Administration is going to pay you an amount that equals the higher of the two benefits. So here's a key point here. You don't get both. You get maybe, I don't want to say one or the other, but essentially you don't get, so let's just say spouse A's Social Security is $4,000 a month. Spouse B's Social Security is $1,500 a month. Okay. So half of spouse A's benefit is $2,000. Your spouse B, you don't get the $2,000 plus your $1,500. You get your $1,500. They true you up to $2,000. So you get like an additional $500. So your spousal benefit does kick in, but it just adds to your current benefits. Moral of the story is you'll be trued up to at least usually about half of the spouse A's benefit. Now, we're obviously generalizing here. It may not be dollar for dollar, but it's pretty close. So that's something to keep in mind. You don't get both. Now, if spouse A's benefit is $4,000 a month and spouse B's benefit is $3,000 a month, there's no true up. It's spouse A gets their benefit and spouse B gets their own benefit. That's something to keep in mind there. Tip number 7, if something happens to you, your spouse and or minor or disabled children may be eligible for benefits. So when you die, your spouse, if they're over age 60 or if they're caring for any children younger than 16, they might be eligible for a survivor benefit. Survivor benefits may be as much as 100% of the deceased person's benefit. And you want to keep in mind that the benefits are going to vary for each person's situation. So that is definitely a call into somebody like your financial advisor to talk you through that, and a call to the Social Security office. I have been on the phone with a couple clients into the Social Security office, and I know a couple of my clients have gone into the Social Security office, and they usually get pretty good information when they're in the offices of the Social Security Administration. There's a lot of good information out there if you need a little bit more guidance. Key fact number 8 about Social Security is that your Social Security benefits may be taxable. I know you're like, wait a minute. minute, didn't I pay taxes for the Social Security? Didn't I earn that benefit? Yeah, but guess what? Uncle Sam says he wants a piece of the pie. We can't fight that uphill battle. So for right now, we do have to pay taxes on some of your Social Security at different stages. So if your combined income exceeds $32,000, if you're filing jointly, and if you're filing as an individual, the number is $25,000. So at those numbers, you may wind up paying taxes on some of your Social Security benefit. Now, no one pays taxes on more than 85% of their Social Security benefits. So they give you that little bit that's tax free. So combined income does include adjusted gross income, tax exempt interest, and half of your Social Security benefits. So let's go through each grouping. So again, if you make under $25,000 as a single filer and under $32,000 as a married filing jointly, your Social Security benefit is not included in your income. Now we go to the next phase. If you're single and your income is between $25,000 and $34,000, up to 50% of your Social Security benefit is included in income and taxed. Now, if you're marrying filing jointly, the amount is earning between $32,000 and $44,000 of combined income. That's when up to 50% of your Social Security benefit is included in your income and tax. The next set of the groupings of that is if you're making over $34,000 as a single filer and over $44,000 as married filing joint, up to 85% of your Social Security benefits are included in your income and tax. So keep that in mind. It is what it is, right? We have to pay our taxes, and Uncle Sam needs to help somebody else with that money. Key fact number 9, certain kinds of income will not increase the taxability of your Social Security benefits. So preferred asset classes such as qualified Roth IRAs or Roth 401k distributions are not included in combined income. Also, assets that have a cost basis, the cost basis is exempt from the calculation. Now, these assets generally include security purchase price in the case of a taxable investment account, also non-deductible IRA contributions, and the principal investment portion of an annuity distribution are included in that. So examples of combined income exclusions could be, again, Roth IRA and Roth 401k or 403b distributions, qualified charitable distributions, non-taxable portion of your pension or annuity payments, inheritance and gifts, life insurance proceeds, and HSA withdrawals for qualified medical expenses. HSA is short for health savings account, healthcare savings account, if you want to do it the long way. So that's obviously not an all-inclusive list. You may go to the ssa.gov website if you want to have a little bit longer of a list. You could also ask your accountant about that, but that's just a general kind of, here's an idea of some of the things that would be part of that. Okay, key fact number 10, your Social Security statement is not a direct representation of what you will receive once you do turn your benefit on. The statement is actually an estimate made on the basis of your most recent earnings and the assumption that you will continue to work and earn about the same amount as you currently earn until you reach full retirement age. Now, the statement does not account for pensions received for work not covered by Social Security. Like, that would include certain government employment. And it also does not account for future uncertainties brought about by any changes in your earnings or your work status, or of course the law or the date when you receive or you start receiving benefits. Now, should you still pull that Social Security benefit statement off and take a look at it? Absolutely, because it does give you a good guide of what you may be able to expect. And it also could be something that you give to your financial planner. I know I am always asking my clients for that piece of paper, or not really a piece of paper anymore. They send it to me as a PDF. But that is really important. And when we're talking about retirement planning, because it is a portion of the income that we're going to be talking about for your retirement, or if it's not income, it's part of your cash flow planning. We do use it in our planning, but again, we use it as a guide. And when you actually are about to turn your Social Security on, you do have a meeting with Social Security, whether or not it's in the office anymore or how you have it. They will give you a different different estimate of or a report of what you will receive as you're about to turn that on. So you'll have a little bit more information as you're about to do that. So those are the key things today for the top 10 key facts about Social Security. Don't try to say that very fast because I can't even say it at normal speed. But I think the action item today is, if you haven't already, I would say to pull off your Social Security estimate statement. You can go to ssa.gov and make an account. It is actually one of the most user-friendly government websites I've ever been on. It is very easy to use. They have really improved the statements. I do like the new statements because they give you a bar graph and it shows you the difference for every year. If you were to turn your Social Security on, it gives you an estimate of what your monthly benefit would be if you turned it on at anywhere from age 62 to 70. It breaks it down each year so you can really see what you're giving up if you turn it on a little early. So definitely want people to take advantage of that and get their benefit and share that information with your financial advisor so they can include it in part of your planning. Very important to have conversations about that as you're planning. You don't want to get all the way into retirement before you have that discussion, because a little strategic planning with your Social Security benefit can go a very long way. Okay. Thank you so much for joining me and being patient while I stumbled over a couple words here, but I do appreciate you joining me. Again, I'm Regina McCann-Hess, president of Forge Wealth Management. My website is forgewealth.com, and my Facebook, Instagram, and YouTube is Forge Wealth, and LinkedIn, I'm Regina McCann-Hess. Go make it a great day. Thank you for joining me for this episode of the Women in Wealth podcast. You can watch the founder's video I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities are offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Forge Wealth Management are separate entities from the LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management.